All the cash transaction can be categorized in two parts. It will be either receipt or payment. Cash receipt means cash inflows, cash incomings, or cash generated, whatever you call it. All these receipts can be categorized into three parts: operating activities, investing activities, or financial activities. In the same way, and the second category of cash transaction is payment. You can call it cash payment, cash outflow, cash outgoing, or cash lost. They can be categorized into three parts: operating activities, investing activities, or financial activities. I try to explain you this thing with the help of this example. Suppose on 1st April 2010, A started business cash with rupees 10,000. During the year, he purchased goods rupees 5,000 and he sold all the goods rupees 9,000, and during this year he paid expenses of rupees 1,000. And you are asked to prepare the cash flow statement. For making cash flow statement, you need the balance sheet as well as opening balance sheet. So before we prepare the balance sheet, we have to prepare first of all cash book, then income statement. Only after that we can prepare balance sheet. And after completing balance sheet, we can go for cash flow statement. So I'm going to prepare cash book for you. To capital 10,000, to sales 9,000, total 19,000, by purchases 5,000 rupees, by expenses 1,000 rupees, by balance CD 13,000 rupees. It means in the beginning of the year the cash was 10,000, but at present after 1 year the cash is 13,000. It means there is net inflow of cash of rupees 3,000 rupees. Income statement, or you can call it profit and loss account. So this is the simple income statement. This is the combination of trading account as well as profit and loss account. It's quite easy for you because you have already learned the final accounts in your previous class. So on debit side, opening stock nothing, purchases 5,000, expenses 1,000, and on credit side sales 9,000, by incomes nothing, by closing stock nothing, and total 9,000, and on debit side to net profit 3,000 rupees. So now we have to prepare the balance sheet as on 31st March 2011. Capital 10,000 plus 3, 13,000. Because last year the capital was 10,000 and this company has made profit of rupees 3,000 during this year. So the capital has increased 10,000 to 13,000 rupees. And on asset side there is cash of rupees 13,000. So total of the balance sheet is 13,000. Now you are asked to prepare the cash flow statement. You can see at the cash book or other transactions, all are operating activities. Either they are purchases or sales or expenses or incomes. There is no any other activity which do not fall in the category of operating activities. So there is net increase of rupees 3,000 in cash, and this increase in cash is due to all operating activities. So the net increase due to operating activity is called cash from operation. Be careful. So this 3,000 increase is only due to all the operating activities. That's why I'm going to call it cash from operation. But if you look at carefully at the profit is also rupees 3,000 and your cash from operation is also rupees 3,000. If all operating activities are on cash and there is no closing stock, then net profit and cash from operation is always same. Please pay attention to my words. If all the transactions are cash in the business and there is no closing stock, net profit is always equal to cash from operation. Cash from operation means cash generated on the basis of operating activities. And operating activities are purchases, sales, expenses and incomes. Only 4 items are included in the operating activities. In this question, all the activities were operating. I mean to say all cash transactions belong to operating activities.